Hi, Tony. We are now like halfway through 2024. I think it's an interesting time to have an assessment on how the markets have performed for the first half of the year.
I think it's been an interesting first half of the year. In many ways, I think a lot of the things we've been talking about over the last couple of quarters have been coming through. I'd say the first thing that is most important is that the global economic expansion has continued, and I think it has broadened. The inflationary trend that we saw over the course of last year, where things were improving, continued this year, but a little bit more gradually and a little bit more erratically. But as we're sort of in the halfway point, I think most economists are comforted that that trend of sort of benign backdrop of inflation and sort of moderate, steady improvement continues. And then I guess the last thing I would just say about the first half is I just think this has been a good backdrop for investing. I think both stocks and bonds have done reasonably well. Equities have gained roughly around 12% on a global basis, and most regions have performed quite well and have kept up with this type of performance.
Thanks, Tony. That's really interesting. Maybe I want to ask this question. On the first half of the market, what really surprised you on the upside and on the downside?
I think some of the biggest challenge has kind of just remained inflation. We had a view since the start of the year that we think this is going to continue to improve. And there were certainly periods through the first quarter where the data looked surprising and it kind of, caused some volatility in markets in both stocks and bonds. But as we're sitting here by mid-year, I think a lot of those trends have come through, and I think we're kind of comforted that our calls are on track. I'd say the other thing that maybe surprised us was some of the trends in China. I think, we believed that China had taken a fairly big beating last year and that most of the downside was priced in. Things sort of stabilized over the last quarter, and the second quarter was much better. And for a period, China was the top performing market on a year-to-date basis in 2024, back in May. And so anyway, I think it's been reassuring that there were some scary surprises at the start for China, but things have been turning out better.
So, looking into second half of the year, what would be the main key drivers that you see in terms of supporting the markets, or at least catalysts in terms of getting the markets to move up to the next level?
Okay, so the first thing we highlight is I think is really important for markets at this stage is earnings growth. And the good news there is that as we look around the major regions, we're seeing double-digit earnings growth in virtually all the regions. And that's for both 2024 and for 2025. And that if that comes through, that leads for a good basis to get double-digit market performance growth. Now, I think a lot of investors in the market think interest rate cuts are your most important driver for markets. For us, we think that's sort of a nice add-on, but it's really kind of more of an earnings story that should be the most important. And that should lead to a lot of sort of just bottom-up stories where stock pickers, look at stocks that are performing well and have good stories and good earnings, and that's going to be more of a driver of markets rather than macro stories like GDP and inflation like it has been for the last few years.
So, touching on that, in terms of a more broad-based growth, what are your thoughts on a small handful of technology companies driving the markets? Do you see that changing, especially in terms of a wider range growth, especially in the emerging markets, in particular Asia, Japan, and China?
I think I have a couple answers there. Firstly, when it comes to that whole technology run and the strong performance we've been getting out of a lot of those leaders, I really don't have anything negative to say. But I think what you're alluding to is right also that in the past year, markets have been very narrow in that those were the only ones sort of carrying the market, and we're starting to see better breadth. And I think that theme is going to continue. And then also, I think the same thing applies to regions. So, for example, you mentioned the emerging markets, and I think that's right to highlight that. I think we like what we're seeing in the emerging markets. We're seeing better export-import numbers around the world. We're seeing the emerging markets see their manufacturing data start to improve, and their valuations are good, and their earnings are starting to come through. So I think there's exciting opportunities in many parts in the world.
Thank you, Tony. Let's move into fixed income. What's your views in terms of the performance of fixed income markets in the first half? And how would you position our clients' portfolio in fixed income going forward?
We continue to like fixed income. We think the yields are good and that the yields are really one of the the key elements of what we model out to be our expected returns in the next couple of years. Well, we are overweight equities, but we really like what we're seeing in fixed income, and we expect the returns over the next year or two to be better than anything we've seen in over a decade. Within fixed income, the way we recommend positioning is to focus first on credits. Credits are corporate bonds instead of government bonds. And this is because the global growth environment is strong enough that most corporates are probably going to be quite healthy, and therefore their credit ratings and their bonds are going to do well. And we would highlight that we like high yield even in this environment, and a good combination of high yield and investment grade credit is probably good for most portfolios. On a global basis, we tend to find that some of the best sort of yield enhancement opportunities, the most attractive bonds, are actually in the Asia region. And so we've been buying up a lot of sort of US dollar denominated bonds that are based from companies in Asia, and we find the yields are there, and that the fundamentals on the companies are looking solid, and we see a lot of opportunities.
Thanks, Tony. At the start of the year, the difference between fixed deposit, cash-like instruments, and fixed income were relatively similar. Do you see these changing?
I definitely have heard that point from clients we've spoken to, that fixed deposit rates are so attractive. Should we really be bothering with stocks and bonds and fixed income? And the answer I would say is that, yeah, really over the last 18 months, as attractive as those fixed deposit rates are, really stocks and bonds are doing better. And I think that difference is going to get even more significant in the next year or two. And I think, what the banks are positioning for as they offer deposit rates is, I think they're aware that rate cuts are probably going to come from the US and sort of set the tone for the rest of the world. And therefore, when we look at the fixed income markets, we see longer durations that will allow investors to lock that in for a longer period of time and just allow more sort of active investment opportunities and ideas. And so, as attractive as those fixed deposit rates are, I do think that there's opportunities elsewhere. And I would encourage investors to, at least, gradually dollar cost average into some of that, rather than sort of be on the sidelines and, be sort of caught when interest rates are eventually cut.
So, Tony, can you help us summarize what can investors expect for the second half of the year?
The way I would think of it is, I see sort of nice stable returns. I don't mean to promise, big double digit returns every quarter. I think it's just that the backdrop is pretty steady, and this allows these underlying asset classes to do quite well. So I think the outlook looks quite good, and I think a good balanced approach is a good way to go. And if you were to ask me what I think performs best, I mean, I think it's stocks will end up giving us the higher returns, but I think fixed income looks great on a sort of a risk reward basis in terms of, having lower volatility, but good attractive yields.
Thank you, Tony, for your time today. It was really, really interesting discussion.